Friends, thank you for being here today. What if I told you that the stability we see on the surface of our economy, the lower gas prices, the strong dollar headlines, the calming of inflation data, is actually the camouflage for a structural break in the global financial system that will define the rest of this decade? And what if the very moves being made to secure cheaper energy for your car and your home are the exact same moves that are quietly dismantling the trust that supports the value of your savings and the safety of the bond market? The moment we are living through right now is not just another geopolitical episode or temporary spike in market volatility. It marks a profound structural break in how power, money, and energy interact on a global scale. We are witnessing the opening signal of something far more fragile than what we have been led to believe. To understand where we are going, we have to strip away the noise of the daily news cycle and look at the machinery beneath the floorboards of the global economy. For decades, the global system functioned on a handshake, an unspoken agreement that was as powerful as any treaty. Oil flowed, dollars circulated, and U.S. treasuries acted as the neutral backbone of global savings. Countries didn't have to love the United States, but they trusted the system enough to participate in it. That trust is what kept yields contained, demand stable, and the dollar dominant without needing overt coercion. It was a system governed by economic gravity. But today, gravity is no longer enough. We have entered a phase where the petrodollar system no longer defends itself through trust, but through force. And that, my friends, is always the moment markets start to panic. Let's begin by looking at the end of the neutral era, the time when trust was enough. We need to understand the invisible pillar that has supported American prosperity for the better part of a lifetime. The petrodollar system was never just about oil. It was about the recycling of wealth. When the world bought oil, they paid in dollars. When oil producers earned those dollars, they didn't stuff them under a mattress. They recycled them back into U.S. treasuries. This created a beautiful, virtuous cycle for the American economy. We bought energy, and the money came right back to fund our government, keeping interest rates low and allowing us to run deficits without immediate consequences. But that cycle relied on one critical assumption: neutrality. Global investors, central banks, and sovereign wealth funds held U.S. debt because it was assumed to be untouchable, apolitical, and universally acceptable. It was the risk-free asset. But what we are seeing now is the quiet admission that this equilibrium is breaking down. When a reserve system has to be actively protected through geopolitical intervention, it signals that organic demand is no longer sufficient. The United States is currently attempting to reinforce the petrodollar by reasserting control over energy supply chains, specifically in South America. In the short term, this appears powerful. More oil supply under U.S. influence means lower domestic energy prices, temporary inflation relief, and an apparent strengthening of the dollar. But markets do not price today, they price trajectories. And the trajectory this move reveals is deeply unsettling to the holders of our debt. The problem is not oil. Oil has always been geopolitical. The problem is what this action communicates to capital holders around the world. It tells them that the dollar AS dominance now depends less on economic merit and more on strategic enforcement. That subtle shift changes the risk profile of every dollar-denominated asset in your retirement portfolio. If energy, trade, and reserves are being actively weaponized, then neutrality disappears. Once neutrality disappears, bonds are no longer just financial instruments. They become political exposure. This is where the panic truly begins. Not on oil futures screens, not in headline inflation numbers, but deep inside the bond market. Large players do not panic sell in a way that makes the evening news. They rebalance, they diversify. They quietly reduce exposure over time. That is how true financial shifts occur. The assumption that the dollar rules because it is indispensable is being replaced with the reality that it must now be defended. And defense is expensive. To see this dynamic in action, we have to examine the Venezuela paradox and the coming oil reset. To understand the mechanics of this shift, we must look at the epicenter of the current energy strategy, Venezuela. This is not primarily a political story, despite what the headlines might tell you. It is a structural one. We are witnessing the early phase of a systemic reordering of the global oil market, triggered by a single geographic pressure point, but designed to ripple across energy flows worldwide. Venezuela represents one of the most extreme paradoxes in modern economic history. It is a nation sitting on the largest proven oil reserves on Earth, more than Saudi Arabia, more than the United States, yet it functions as a broken asset. For years, massive reserves have been trapped beneath deteriorating infrastructure, outdated technology, and political isolation. Oil that cannot be efficiently extracted, refined, and transported is not power, it is dormant wealth. And in the ruthless logic of global economics, dormant wealth invites intervention. The United States moving into Venezuela is an engineering project disguised as a geopolitical maneuver. The goal is to seize the levers of this broken asset, the pipelines, the refineries, the logistics. Why? Because whoever rebuilds and manages the flow controls not just the revenue streams, but the pricing influence. American oil companies do not enter markets for charity. They enter when the math works. Venezuela's infrastructure decay, combined with its reserve scale, creates one of the most asymmetric opportunities in the energy world. Relatively modest investment compared to finding new oil elsewhere can unlock massive volumes of supply. This is the hidden logic driving the reset. Historically, Venezuela produced over 3 million barrels per day. Today, it is a fraction of that. Bridging that gap would flood the market with supply. From the perspective of Washington, this is a masterstroke for domestic stability. Increased control over oil supply can suppress domestic energy prices, providing political relief and easing inflation pressures. Lower energy costs support manufacturing, data centers, and industrial reshoring efforts. It acts as a hidden tax cut for every American household. However, there is a catch. When you artificially suppress the price of the most strategic commodity on Earth by taking physical control of it, you send a shockwave through the financial system. You are prioritizing the American consumer at the expense of the global producer. You're telling the world that the price of oil is no longer set by a free market, but by American strategic necessity. Markets are exceptionally good at distinguishing between temporary relief and structural repair. They understand that controlling oil does not fix the U.S. debt trajectory. It does not reduce deficits. It merely masks symptoms while increasing exposure. By tying financial stability more directly to geopolitical dominance, the system becomes more brittle. Every future conflict carries monetary consequences. But there is a trap hidden in this strategy, a conflict between cheap oil and expensive debt. Here lies the core contradiction that threatens your financial future. The United States is engaging in a trade-off. We are buying cheaper oil today at the cost of more expensive debt tomorrow. The strength of the petrodollar was never oil itself. It was trust in the recycling mechanism, in the bond market, in the idea that holding U.S. debt was a neutral act. Once that trust erodes, the system does not collapse overnight, but it starts demanding higher compensation for participation. Think of it like a credit score for a nation. If a bank suspects a borrower is relying on force rather than income to pay their bills, they raise the interest rate. The global bond market is doing exactly that to the United States. If the petrodollar needs aggressive reinforcement, then demand for dollars is under pressure. If demand is under pressure, yields, the interest rate the U.S. government pays to borrow, must rise to compensate investors for the added risk. And if yields rise structurally, the cost of maintaining the entire U.S. system increases dramatically. This is why the reaction is not immediate chaos, but slow, methodical repricing. The U.S. government is uniquely sensitive to this dynamic because of the scale involved. With debt levels already extreme, even small increases in average interest rates translate into enormous increases in servicing costs. We are entering a period where the bond market is being asked to absorb more supply at precisely the moment when its largest holders are reassessing their exposure. That mismatch is where panic is born, not through headlines, but through math. The immediate benefits of the oil strategy, lower gas prices, a temporary dip in inflation, are visible and politically popular, but the costs are hidden in the bond market. Lower energy prices may suppress inflation temporarily, but they also reinforce a policy mix that depends on ever-increasing debt issuance. The system saves on one line item while bleeding on another, and the bleeding is structural. Capital does not ask who is right. It asks who is safe. From the market's perspective, if the U.S. is willing to use hard power to secure economic outcomes in Venezuela, then financial assets denominated in dollars are no longer purely economic holdings. They represent alignment risk. Even if asset freezes or sanctions are not immediate, the precedent matters. Before we move on to how the rest of the world is reacting, I want to pause and ask for your perspective on this critical trade-off. Do you believe the short-term benefit of lower gas prices is worth the long-term risk to the dollar's stability and our national debt? It is a complex issue with no easy answers, so please share your thoughts in the comments below. I would love to read what you think. This naturally brings us to the China factor and what we can call their silent exit. We cannot discuss this global shift without addressing the elephant in the room, China. For years, Beijing sat at the center of the Venezuelan story, not as a savior rebuilding the industry, but as a pragmatic buyer securing discounted supply. This arrangement suited China perfectly. They gained access to energy flows that bypassed Western control, and Venezuela became a critical node in China's broader push to expand its economic footprint. The U.S. move into Venezuela effectively cuts China out of this loop. It displaces them from a strategic energy node. On the surface, this looks like a clear victory for the United States. We have secured the resources. Our rival has lost them. But China's response is not going to be a dramatic military confrontation. It is going to be financial, patient, and asymmetric. China sits at the center of the global response, not because it wants conflict, but because it has the most to lose from a system that is increasingly being weaponized. China does not need to confront the system directly. It simply needs to reduce its exposure to it. This reduction does not look like panic selling. It looks like steady diversification, slower accumulation of U.S. treasuries, increased use of local currencies in bilateral trade, expansion of commodity-backed agreements. The key point is that this response is not ideological, it is defensive. If the dollar can be used as leverage today, it can be used as pressure tomorrow. Rational actors adapt to that reality. China understands deeply that dependence on the dollar system now carries political conditions. This creates a vacuum in the bond market. For decades, China and other emerging economies were the marginal buyers of U.S. debt. They bought the bonds that funded our deficits. As they step back, who fills the void? The answer is likely the Federal Reserve or domestic buyers, but at a much higher cost. The irony is that the petrodollar plan, intended to slow de-dollarization, actually accelerates it at the margin. By demonstrating that energy supply and currency settlement are now strategic tools, the United States incentivizes other actors to reduce their exposure wherever possible. Even partial success compounds over time. A small reduction in dollar usage today becomes a larger reduction tomorrow as networks and habits change. While currencies play games, we must listen to the truth tellers of the market, gold and silver. While the bond market whispers its unease, another asset class is shouting, precious metals. In a traditional economic model, a strong dollar and high interest rates should crush the price of gold. Gold pays no interest. It costs money to store. When the dollar is king, gold usually suffers. Yet, we are seeing gold and silver prices remain resilient and trending upward even as the dollar appears strong. Why? Because gold and silver are no longer trading on inflation expectations alone. They are trading on trust. Precious metals are often misunderstood as reactions to inflation alone. In reality, their most powerful rallies occur when trust in institutions erodes. They respond to questions that cannot be answered by policy statements or rate decisions, questions about reserve safety, questions about asset neutrality, questions about whether the rules of the system will still apply tomorrow. Central banks understand this dynamic better than most retail investors. That is why official gold purchases accelerate during periods of geopolitical tension. These institutions are not chasing returns. They are managing risk. Gold sits on the balance sheet as an asset with no counterparty. It cannot be frozen. It cannot be sanctioned. It cannot be defaulted upon. In a world where financial systems are increasingly weaponized, those characteristics matter more than yield. The current environment is a textbook case of divergence. The dollar receives a short-term boost from energy control, while long-term confidence quietly deteriorates. Gold captures that contradiction perfectly. It rises not because the dollar is collapsing today, but because its future reliability is being discounted. Silver follows a similar logic, but with an added layer. It sits at the intersection of monetary distrust and industrial demand. As global supply chains fragment and energy becomes a strategic variable, silver's dual role makes it a barometer of both financial stress and structural reconfiguration. When you see metals rising alongside a strong dollar, do not be confused. It is the market pricing in a world where diversification is not optional. It is the market signaling that the risk-free status of the dollar is under review. Investors are not betting on disaster. They are preparing for unpredictability. And unpredictability is the enemy of leveraged systems. Now we need to define what bond panic really looks like inside a narrowing economic corridor. So, what does this panic actually look like? It is vital to understand that panic in the bond market is not like a stock market crash. It is not people screaming on the trading floor. It is a cold, rational, mathematical realization that the numbers no longer add up. Panic is a gradual reduction in marginal demand. It is fewer aggressive bids at government auctions. It is a greater preference for shorter maturities, loaning money to the government for 3 months instead of 30 years. It is increased diversification into non-dollar assets. None of these moves cause a crash on their own. Together, they reshape the yield curve and the funding cost of the entire system. The United States government is finding itself in a narrowing corridor. On one side, it needs to keep interest rates low to afford its massive debt pile. On the other side, it needs to keep interest rates high to attract buyers who are increasingly skeptical of the dollar's neutrality. The Petrodollar plan, the seizure of Venezuelan oil control, buys time. It pushes down inflation and creates the illusion of control. But time is expensive. The longer the system relies on commodity control to maintain balance, the higher the eventual adjustment cost becomes. We are witnessing a transition from a system based on confidence to a system based on compliance. Confidence sustains systems effortlessly. Compliance requires constant pressure. Pressure creates friction. Friction encourages alternatives. Once alternatives exist, confidence never fully returns. The bond market is forward-looking by nature. It prices not what is happening today, but what must happen to sustain the system tomorrow. And sustaining a system that relies increasingly on coercion requires ever greater financial concessions. This leads to the enforcement tax. To keep the dollar dominant, the U.S. must spend more on military, more on intelligence, and more on strategic interventions. These costs increase the deficit. The increased deficit requires more bond issuance. The increased bond issuance requires more buyers. But the very actions taken to enforce dominance, like the Venezuelan move, scare away the buyers. It is a feedback loop, and the release valve for this pressure is higher yields. We cannot ignore that these economic moves also have profound social and moral dimensions. We must also touch upon the human element of this reset. Economic decisions do not operate in a vacuum. The oil reset underscores the fact that economic decisions operate within a broader social context. When energy control changes hands, lives are affected. Venezuela's broken state created space for China, and its reactivation under U.S. influence closes that space. But this is not just about nations, it is about communities. The shift favors actors who can deploy resources quickly and absorb complexity. It penalizes those who rely on inertia. There is a moral hazard in rebuilding a nation's economy primarily to serve the inflation goals of another. The reimbursement narrative used by Washington, that we are taking oil to pay back debts, legitimizes aggressive production strategies. But it also raises questions about sovereignty that the rest of the global South is watching closely. If the United States can effectively repossess the energy infrastructure of a sovereign nation to stabilize its own currency, what does that say about the safety of assets held by other nations? This moral and legal ambiguity adds another layer of risk premium to U.S. assets. It forces participants to confront the trio that underpins sustainable decision-making: legality, financial viability, and moral coherence. Ignoring any one of these elements introduces risk. This leads us to a hidden consequence that rarely makes the headlines: the end of the peace dividend and the structural return of volatility. To truly grasp the magnitude of this shift, we must look beyond the bond tickers and oil barrels to see what is happening to the very texture of the global economy. For the last 30 years, since the fall of the Berlin Wall, we have lived in a unique historical anomaly. We lived in an era of hyper-globalization where efficiency was the only god. Supply chains were stretched thin across the globe to find the absolute lowest price for everything, from the chip in your toaster to the shirt on your back. This was the Peace Dividend. Because we assumed geopolitical stability, we could prioritize cheap goods over secure supply. This pushed inflation down and allowed your retirement savings to stretch further. But that era is officially over. By weaponizing the financial system and turning energy into a strategic battleground, we have shattered the illusion of stability that allowed hyper-efficiency to exist. We are moving from a just-in-time economy to a just-in-case economy. Companies and nations are no longer looking for the cheapest supplier. They are looking for the safest one. They are building redundant factories, hoarding inventories, and moving production to friendly but more expensive shores. The shift is inflationary by nature. Resilience is expensive. Efficiency is cheap. When you prioritize national security over economic efficiency, the cost of everything rises. This is the invisible tax of the new order. It means that even if the U.S. succeeds in pushing oil prices down through the Venezuelan reset, the baseline cost of living may stay stubbornly high because the global supply chain is broken. Furthermore, we are witnessing the bifurcation of the global economy. We are slowly splitting into two distinct trading blocks: the dollar block and the emerging BRICS-gold block. As these two spheres separate, the friction of trade increases. You can no longer seamlessly move capital or goods between East and West without navigating a minefield of sanctions, tariffs, and compliance checks. This friction acts like sand in the gears of the global economy, slowing growth and increasing volatility. For the older generation, this return of volatility is perhaps the most dangerous aspect of the shift. In a high-trust, low-volatility world, it was easy to plan for the future. You knew what your money would buy. But in a low-trust, high-volatility world, black swan events, those rare, unpredictable shocks, become common. 1 month oil is crashing because of a U.S. maneuver. The next month it is spiking because of a retaliation in the Strait of Hormuz. 1 month bonds are stable. The next they are repricing violently because a major foreign buyer decided to exit. This environment creates a volatility trap. Markets may appear calm on the surface because of heavy government intervention, like the suppression of oil prices, but underneath, the pressure is building. When the dam finally breaks, the moves are violent and swift. This makes the traditional buy and hold strategy perilous. If you are sitting in a standard portfolio designed for the peaceful 1990s, you're exposed to the weaponized economics of the 2020s. The end of the peace dividend also means the end of the easy money era for the government. During the peaceful globalization era, the U.S. could print money without causing immediate hyperinflation because cheap global labor and goods soaked up those dollars. That deflationary buffer is gone. Now, every dollar printed to fund a deficit or a war goes directly into a constrained, fragmented supply chain, sparking immediate price heat. This ties the hands of the Federal Reserve and limits their ability to bail out the markets during the next crisis without destroying the currency. Recognizing this structural change is not about being pessimistic. It is about being realistic. The wind has changed direction. We are no longer sailing with the current of globalization. We are sailing against the headwinds of fragmentation. And in such waters, the vessel of your financial security requires a much steadier hand and a different map. You might be asking, what does this significant shift mean for you personally? Friends, I know this analysis can seem heavy. It paints a picture of a world that is becoming more complex, more volatile, and more expensive. But the purpose of understanding this is not to induce fear, it is to induce clarity. The petrodollar panic is not a signal that the world is ending. It is a signal that the world is changing. The era of easy American dominance, where we could print money without consequence and buy cheap oil without effort, is drawing to a close. We are entering a period where dominance is conditional. Conditional dominance is expensive. It requires incentives, higher yields, and constant reinforcement. For those of us looking to preserve wealth, this shift demands a change in mindset. The strategies that worked in the last 40 years, the set it and forget it portfolio of 60% stocks and 40% bonds, may not provide the same safety in a world where bonds have become political instruments. The rise of gold, the diversification of central banks, the stubbornness of inflation, and the volatility of energy markets are all symptoms of the same root cause, the repricing of trust. The oil war stabilizes one side of the equation, prices, while destabilizing the other, bonds. From a strategic perspective, this creates a fragile equilibrium. The U.S. can keep energy flowing and prices contained for a time, but doing so requires constant intervention. Intervention increases geopolitical tension. Tension raises risk premiums. Risk premiums raise borrowing costs. The cycle tightens. What began as an effort to simplify the system ends up making it more complex and less forgiving. Markets sense this fragility. They do not reward it with renewed confidence. They tolerate it cautiously. That tolerance is conditional and easily withdrawn. If you are finding value in this analysis and want to stay informed as we navigate these financial shifts together, please consider liking this video and subscribing to the channel. Your support truly helps us continue to provide this kind of independent deep dive content. Finally, let's look ahead at the new reality facing us all. To wrap this up, we must look at the horizon with clear eyes. The United States has successfully engaged in a maneuver to secure cheap oil from Venezuela. In the short term, you will likely see the benefits at the gas pump and in lower heating bills. You will see politicians claiming victory over inflation. You will see the dollar looking strong against other currencies. But look deeper. Look at the bond yields. Look at the price of gold. Look at the quiet movements of the Chinese central bank. The global order has not ended, but it has shifted. Power is no longer exercised quietly through financial gravity alone. It is being asserted openly through strategic moves tied to energy and currency. That change alone is enough to trigger a global reassessment of risk. The panic is the realization that the old assumptions no longer hold. The assumption that the dollar rules because it is indispensable is being replaced with the reality that it must now be defended. The assumption that U.S. debt will always be absorbed without friction is under scrutiny. We are moving from a world of organic trust to a world of strategic enforcement. While enforcement can be effective, it is costly, it breeds resistance, and ultimately it changes the value of money itself. The petrodollar plan buys time, but time is being used by others, by China, by the BRICS nations, by astute investors, to prepare for a different future. A future where the dollar still dominates, but at a much higher cost, with much greater volatility, and with far less tolerance for shocks. The oil reset sets a precedent. It establishes a template for how future resource-driven adjustments will unfold. It shows that power is exercised through systems, not slogans. It reinforces a fundamental truth. Stability is not the absence of change, but the capacity to manage it. Those who understand that the ground has shifted can position themselves for resilience. Those who believe that yesterday's rules still apply are the ones who will be caught off guard. The panic is not loud. It is disciplined, methodical, and deeply rational. It is spreading through the one place the system can least afford it, the market that funds everything else. Thank you for your time, your attention, and for your willingness to look beyond the headlines. In a world of noise, understanding the signal is the most valuable asset you can own.